We have Dohn Thornton with me here tonight. Don, I really appreciate your time, and I'm going to send everybody to your website, Don, because you have an offer for them where you can talk and learn a little bit more about legally reducing your taxes by as much as 90% or more. And we're going to talk about some of those options here tonight. But head over to Financial Freedom for You, and that's the number 4 and the letter U .now.site. And I'm going to have that link in the show notes. So swipe over on your podcasting app and find that as a clickable link. So, Don, I really appreciate your time here tonight.
Thank you for having me.
So let's start things off by asking you, well, based on some of the information I've seen regarding you, you've been in real estate investing for quite some time.
Yes, this is my 20th year. Actually, December was my 21st year, and I spent most of that time specializing in short sales. And that's why
really?
my shtick is Don the short sale guy. That's how I branded myself all these years. And because that's really all I want to do is short sales.
Sure. How did you find your way into that niche? I know there's not a ton of people out there that do focus on short sales.
Well, you got to remember, I started this back in 2002. So back then, nobody was doing them, which was to my advantage. But I just felt like I come from a finance background, and I just felt like the concept that you could take an asset that is almost like a liability because an upside down house with no equity, negative equity, no, traditionally wholesalers don't want it. Most people don't want that. And so you could literally just say, hey, I'll take, if you're in foreclosure, I go knock on your door back in those days. I'd say, I want to buy your house. I'd say, no, you don't want it. I said, why wouldn't I want it? He said, well, because we owe more than what it's worth. I said, I don't care. I'll take it. And they would drive down to the local UPS store and they would sign a deed over to me right then. And then it was simpler to do it back then. You can't do that now. But at the time, it was just like, as a newbie, I picked up 36 houses in 10 weeks, I think it was. And but the idea that I could take this house that nobody wants, that has no value, and just by negotiating, I could create a $20 to $50 to $80,000 profit. That was like, wow, no risk either. So I thought to myself, you know what? I'm in. That's what I want to do. And I just never stopped.
Well, you said it was easier back then, but are you still doing that today?
Oh, yes. It's just my exit strategies are different now than they are.
Oh, sure. How has it changed?
Well, back then it was strictly buy it, rehab it, and then put it back on the market. I don't do that anymore. I stopped rehabbing about 4 years ago. I just found that I just did A/B testing and realized that actually I was netting more by not rehabbing and not taking. And I had so much more cost when it came to the rehabbing than it was with just. I started off by doing just lipstick on a pig, just sweep it up, make it look a little better, and just throw it out there. And then even then I said, you know what, there's got to be a better way to do this. And so I was able to work out a way to make nice money, $18,000 per sale, and never take title to it. It was almost like the concept is the same of wholesaling, but it's different because it's a short sale and the lender has to approve it. So we really had to put our thinking caps on and figure out how to do it. But we came up with it, and we're in our 5th year of doing that, and it works wonderfully.
Yeah, we kind of ended up in the same results. We used to do a lot of flipping as well, and frankly, we came to the same conclusion. So we do something what we call wholetailing to a certain extent now, where when we do get a property under contract, we try to do as little as possible, get it cleaned up, and then just get it churned as fast as possible. Because you're right, you can when you take into account all of the rehab and the time and the cost of money and everything associated with it, sometimes you're better off just churn and burn.
I think that people they fall in love with the Flip This House and different programs that are on TV. And they're so focused on oh, I want to do this and that, and oh, this look great, and it's all about what's in your pocket when the deal's over with. That's all that matters. The house is just the instrument for you to make money. And so if you can make a nice money, and you can keep moving and moving and moving, if you have the pipeline, then it's the only way to do it, in my opinion.
Yeah, you're absolutely right. I think we can thank HGTV and a few of those other channels thanks to that. There's like this romanticism around flipping houses,
Hmm.
and it's never, and I can guarantee you there's not a lot of people who can pull it off in 30 minutes or less.
Yeah.
So this, we could probably spend an entire episode talking about your negotiations and that process associated with banks and getting them convinced regarding the short sale process. I mean, there's got to be a lot of skill associated with
Yes.
that.
You have experience. I mean, you do something this long, you get good at it, or you move to something else.
Did you find that it's easier to talk to the smaller banks than larger ones
You know,
when it
large
comes to that? Larger ones every time, huh?
every time. The smaller ones, they get more into the nitty gritty. As long as you can give the large banks negotiators what they want in a format that they prefer, they will give you, and you start developing a relationship with these people. A level of trust will develops, and they will almost pretty much just rubber stamp it, and that's what we've been able to accomplish.
Well, I've learned too, because I actually have a banking background as well, and I've learned too is that once you start to learn their process and what they're looking for,
Mhm.
and you start to tailor your packets associated with it, I'm sure you probably get noticed more than once when you kind of figure out their process, and it's typically all about the numbers when it comes to them.
And you want to give
More
the
predictable.
Yes, and you don't take advantage of their trust either, so you don't get greedy, which is a big
Right.
thing. The biggest
Right.
mistake people make in short sales, they think it's easy and they go for too much and they get slapped. And they
Right.
lose all credibility with that negotiator, which we do not. That is gold for us, and we will make sure that we do not ever come off as greedy or trying to pull a fast one. And that will burn your bridges as fast as you can do that.
Right. Well, so one thing leads to another, and we're talking here tonight. I want to make sure we have enough time for this. So you're talking about legally reducing your taxes. In your process, what do you focus on in order to accomplish this?
Well, I'm a short sale flipper in the sense that, well, because when I stopped taking houses and rehabbing them and put them out for sale again, I just started basically, like you said, wholesaling in a sense, with a short sale emphasis on it. All my income was ordinary
Hmm.
active income, and when you get above $165,000 a year, then you're taxed between 32 to 37%, which is a big chunk of your money. And
Hmm.
so that was always the challenge for me was how in the world can I do this without paying so much in taxes? And you can play the write-off game as much as you want, but nevertheless you're still, I mean, you're playing Russian roulette with the IRS that way anyway. But there had to be a mechanism out there. I knew there had to be something out there where you could not have to pay so much in taxes. And where there's a will, there's a way. And I was able to find a source to where we were able to find out that, okay, there is a trust out there. It's called a non-grantor, irrevocable, complex, discretionary spendthrift trust. And there is an IRS tax code that has to do specifically with that kind of trust. And what you can do is, this is what anybody would do to real estate investing genre is the trust is created, you're made the trustee. Okay. You establish your
Hmm.
bank account, and then you sell your personal and your business assets to the trust. Okay. That meant any properties that I owned, I sell them to the trust. My own personal residence, my own vehicles, any assets sold to the trust. Now, thing is, you don't sell it at fair market value. You sell it at the price you acquired the asset at. Okay. So,
Hmm.
for example, my wife and I got married in '99, and then we moved to Orlando, and we bought a house. It was $155,000 in 2001. No, 2000, I think it was. So, of course, it's not worth that now. But when we sold it, that was the price. And you may be asking, well, why would you do that? Because you don't want to create a capital gains event when you sell the asset to the trust. Because the trust is irrevocable, you can't transfer assets back and forth. It has to be sold. But you want to do it in a way to where you're not going to pay taxes on the transaction. So all of these assets, my personal, my business, everything is sold into the trust. So now the spendthrift provision of this trust, it's the very last one of the name I just gave you, that gives you 100% lawsuit-proof asset protection. That doesn't mean that you can't prevent someone from suing you. What it does mean is that when it gets in front of a judge, the judge is going to say, you can't sue this trust. It has a spendthrift provision. It's untouchable. Only way it's been penetrated in hundreds of years is if somebody can prove there was fraud involved. And as long as you're, minding your P's and Q's, no one's going to get you. They can't get any overturn orders. They can't get any seizures. They can't come in and they can't get you personally. They can't get you as trustee, and the trust is impenetrable. So now your assets are locked down 100%. But that's the asset protection part, and that's exciting. I could talk an hour about that, but I want to tell you about the tax stuff. The tax stuff's fun. Okay. So what you do is you form an LLC, and you have the trust becomes a 90% limited partner in the LLC. So I have 10%, but I'm the managing partner. The trust has a 90% limited partnership in the trust. So I'm gonna instead of running my business through my S corp like I did for 19 years, now I've got my LLC, but the only issue is that the LLC does not have any assets with which it can generate revenue. So what we're going to do is, since all my business assets are in the trust is going to lease those assets to my LLC. So now everything's hunky-dory. I can go out and do my normal business, calling up foreclosures, networking with people to get referrals for upside down properties. We do our business, we flip, we, make our money. And so at the end of the year, let's say that, my gross revenue was 1.2 million. Okay. I go through and do my write-offs, deductions like you normally do. And let's say that that leaves me with a pre-tax net income of $1 million. Now, normally that's where I would be calculating what my tax burden would be for that year. And since I'm at ordinary income, that would be 32% or $320,000, right? So that's a big chunk. So, but the difference is that there's two more expenses that we can use to bring that LLC's tax burden down to almost nothing. And this is going to be crazy. Remember I told you that we lease the assets from the trust to the LLC. Now the IRS will allow up to 70% of your pre-tax net income to be used as a lease payment for those assets. So we're going to take 700,000 of the 1 million net income, and that's going to be sent to the trust as a lease payment for those assets. Okay. So now we have reduced that pre-tax net income from $1 million down to 300,000. Okay. Now there's one more trick left to go. Remember that the trust is a 90% limited partner in the LLC. It needs to get paid for its equity position. So 90% of the $300,000 that's left over, or $270,000, is going to be transferred over to the trust as a K1 distribution for that equity position. So now our LLC was $1 million. Good job. You did a great job. And oh, wait for Uncle Sam. Now it's like, well, you only made $30,000 this year. All that work, and you made $30,000. That's where you're going to calculate your taxes. Okay. So I think you can see that your LLC is not going to owe much of anything from the taxes. Okay. We're going to shift gears. We're going to go back over to the trust, because you're probably thinking to yourself, well, the trust is going to have to pay taxes, right? No. I'll tell you why. Because of the special nature of this trust and the fact that it is in accordance with IRS Code 643. As trustee of this trust, I have full discretion. That's why it's called a discretionary trust. Remember? Non-grantor, irrevocable, complex, discretionary spendthrift trust. Okay. The discretionary part is very important because I have 100% control and authority to take those two passive income payments that came in, the lease payment and the K1 distribution. Now I can declare them to be an extraordinary dividend for the trust, which means that any taxes that would have been paid on that will be deferred in perpetuity. They will never be paid. Okay. And oh, by the way, just as a bonus, if I'm not a buy and hold guy, but if I was, let's say that I had a duplex that I hold for a couple years, I said, you know what, I'm going to sell it. So I sell it, and then I'd be paying capital gains tax on that, right? Or I would do a 1031 exchange, which is unwieldy and it costs money and it's not that great, but no one else knows what to do, so they just keep doing the 1031 exchanges. With this strategy, any capital gains taxes can also be deferred in perpetuity. So you don't ever have to do a 1031 exchange again. You can buy and sell your properties without worrying about capital gains, about putting the money back into some property that maybe you don't want to, but you're forced to because you've got to put it somewhere so you don't get killed on capital gains taxes. Now that's over with because the trust owns the property, the trust sells the property, the proceeds come back into the trust. And with this special status that the trust has with this tax code, deferred in perpetuity. As long as that trust exists, taxes are never paid.
This is one of those things that, I followed you. You did a great job explaining this. I followed you the whole way. So some questions that arise. So if you have a property, like you said, your personal house, if you have a property that has a mortgage on it, is there any loopholes or any issues with like a due on sales clause or anything like that?
No. Well, it's similar to a subject to strategy. So what you do is you sell the property, you did a warranty deed, and there's also an assignment of note that's in the trust book. And then you don't record it, you keep it in the trust book. And when it comes time to sell it, then you record it or you give the title company, and then that's how you establish the chain of title.
Okay.
So the trust would pay for the mortgage, not you personally anymore. Your trust is going to be a trust expense.
Okay. And then you'd basically have bank accounts that would, with that trust name and
one bank account.
One bank account. Okay. And then you mentioned leasing back whatever's in the trust. You're establishing this lease.
Assets, yes.
Can the lease amount vary? Like that amount you meant.
We're allowed up to 70% by the IRS, but frankly, why would you not take the maximum?
Right. Yeah. Most of us, when we, it might sound naive, frankly, but most of us, when we say a lease, we think of it as a rental property. There's a fixed amount every month, a lease or a rent payment. But you're suggesting that it can be just simply a percentage.
It's 70% of whatever your pre-tax net income is.
Okay. Okay. So once you got it in the trust, is there a way for you to use those funds, like paying yourself, or how does that piece work? Or does that stay in the LLC? Like you're operating on the 30%.
And sometimes it's a little bit hard for people who have been wired for the write-off syndrome, as I call it, because we're always wondering if we can write stuff off. You change your mentality to, is it a trust expense or not? And I will tell you that the trust can pay for almost everything that you need in your life, not just for your business, right? So vehicles, for example, before you could only write off a certain amount of mileage. Because the vehicle is a trust asset now, the trust pays for everything: gas, maintenance, oil changes, new tires, whatever has to be done, the trust pays for that. So now you don't worry about write-offs anymore. You worry about whether the trust is it a trust expense or not. And pretty much what the trust cannot pay for is what I call the 3 Fs: food, fun, and fashion. That's it. Okay. Even then there's leeways. I mean, there's always gray areas. It depends on how aggressive you are or not. But my point is that, and it's not just me, everyone I've spoken with who owns a trust, they all say in unison, I hardly ever need cash anymore, because the trust pays for pretty much almost everything.
So, just to go back on the lease thing there for a second too, is that when you do a lease back to the LLC, there has to be some paper document like this and establish a written lease, right? So it's all about having that documentation in place. Okay. Yes. So, this sounds too good to be true. So what are the catches here? Like, why isn't everybody just doing this?
People didn't know about it. I was doing real estate for 20 years, never heard about it. It's just now starting to filter down because it's been in the purview with the ultra wealthy for decades. And it just, look, Grant Cardone uses it, right? Warren Buffett, Jerry Jones, the owner of the Cowboys. If you reach a certain level, you're getting a trust. But it's just almost like a secret, a club, the VIP club that unless our noses are pressed against the window looking in, we don't know what's going on in there, in their smoke-filled rooms where all the rich guys or rich women they're all laughing and, oh, well, we're so great because we know everything. Well, now it's drifted down to our level. And that's why I'm so passionate about talking about it, because we should be able to use the same advantages that they have. We're just as good as they are. And you can see that you can have $200 million and benefit from this, and you can make $200,000 and still, save a tremendous amount on your taxes. So why not?
So then you also talked about asset protection. How did you said it's almost impossible to pierce this?
Yep.
And we hear this all the time. In fact, I just had somebody on the show that we talked about piercing that corporate veil. So can you kind of break down or summarize like what creates this better protection through a trust?
The biggest thing is that the legislature, the government and the legislature, they can change, alter, eliminate anything that they create. Okay. So all your corporate entities are creatures of the legislature. Your S corps, your C corps, your LLCs, your land trust. Okay. This trust is different. The spendthrift trust is different because it is based on contract law, not legislative law. Okay. It is a contract between two people or two entities, and it's guaranteed in the Constitution about the fact that their contracts are inviolable in our history in our country. And then I think it was in 1911, I believe it was, or I'm not sure which one it was off the top of my head, but there was a Supreme Court ruling which stated that the government cannot regulate or tax a contract. Okay. So this strategy is based on contract law. It's stuff that everybody else is out there hawking. It's based on legislative law, and whatever the government can creates, the government can take away. Right? Mm-hmm. They cannot regulate or tax a contract like this, and that's what this is you can call it a contract law trust, and that is really why we have the asset protection is almost impenetrable. Like I said, the only way they get penetrated is if you're breaking the law and you're doing fraudulent activities.
Okay, so this is really, you got me really my brain spinning here a little bit, Dohn, in the fact regarding this, and I keep coming back to the concept like, what's the gotchas here? You gave us the three F's, but there's got to be something else. What am I missing?
There isn't.
Really?
There are no gotchas. It really is that simple, and it's that effective.
So you're going to have to pretend I'm just talk to me like I'm a 3-year-old. I have a property, my house here, and I have my mortgage company. I'm mortgaged on this property. The mortgage company doesn't have to really be involved. Like what would I have to do to move that into a trust and not create I don't want a new mortgage. I've locked in a great rate right now.
You don't have to. You don't have to. Like I said, all you would do is you would sell the property to the trust. You would do a warranty deed and a bill of sale, and the price would be whatever the price was when you bought it. All right. And then you also sign a paper called assignment of note, and that's in your trust documents. It's not recorded. The only difference is that now, as soon as that paperwork is completed, notarized, and now the trust is the owner of the property, that it's now an asset of the trust. As trustee, you have the responsibility to maintain and upkeep the assets, including making the mortgage payment, paying for the insurance, anything. If a water heater blows up, the trust pays for it. It's a trust expense. You want to put on a new wing of your house, the trust pays for it. It's a trust expense. Okay. And so there's no due on sale clause danger because it's not being recorded.
Sure. So let's say this even sounds like a good idea for just somebody who is employed 9 to 5 and just for the added protection.
Help W-2 employees.
So,
but no, the asset part, yes. I'm sorry.
Yeah.
The tax reduction doesn't work with W-2 employees.
Right. So let's say let's say I am a W-2 employee and I put my house in this. Can I fund the trust then in order to make the mortgage payment? Am I making sense?
You
Or
would
how
have
does that
to
work?
using post-tax dollars, yes, but you could do that, sure.
Well, is that what you would recommend? Let's say there isn't enough assets there in order to pay all of the mortgages.
Well,
You'd
ideally,
have to do some sort of cash injection, wouldn't you?
ideally, what you want to do is, synchronize a tax strategy like I just described with the asset protection. A lot of people that are W-2 employees that want to buy a trust, they'll go back to their employer and ask if they could be switched to 1099 status, and most of them do. A lot of them do because it saves the company money. At that
Mhm.
point in time, then you're golden. So let's. I
Sure.
was talking to a woman today that she's a W-2 employee, and she also has a consulting company where obviously it's a side hustle, so it's not W-2. But I was telling her how much money she could save with that with her side hustle, and then I said, why don't you go back to your employer and see if they'll switch it to 1099? And we talked earlier this morning, and then before I jumped on the podcast, I got a text from her saying, yes, they said it's okay. We can do this. And so now what'll happen is that like we did in this scenario, right? You have an LLC. So instead of her being paid a W-2, the company will pay her LLC, and then LLC will then pass that income through to the trust, like I described earlier.
Right. Okay. So the trust becomes 90% limited partner of the LLC, and then 70% goes as a lease. And
He is a K1 distribution.
sure. Wow, Don, you blew my mind here tonight. I'm spinning. So again, I'm going to direct everybody financial freedom, the number 4, the letter U.now.site. There's a quick form there. Take advantage of that, and you can learn more about this strategy. But Don, is there anything else we should cover on this? Otherwise, we're going to jump into some of the rapid fire.
The last thing I would say, and I didn't cover this, but with this strategy, you never have to use multiple LLCs or land trusts. You take property in the name of one trust, one EIN number, one bank account. You're free from that tyranny of having to spend money filing LLCs, creating them, annual reports, all the paying, separate returns for your accounting, because you don't need it. Just use this one trust, put all your properties into this trust, and that way you're going to save a ton of money and time for all that accounting BS that you have to go through now.
Sure. Does lead me to like a final question on this. If you don't mind me asking, like, you and your team help with this type of strategy, I'd assume. Do you feel comfortable sharing? Like, what does this setup typically cost?
The beneficial trust is $15,000. It's a one-time investment that includes a full year of unlimited consulting with not just with us, but with the accounting firm that we're allied with, to make sure that everything is set up correctly and make sure that you're comfortable and that you're running your trust. And then also the accounting firm will do your taxes for you for free as part of the initial investment.
Okay.
So that's the that's the initial investment. You can't make payments. You got to wire the money, and but you get your trust like within a week, and you can get started.
Sure. And then beyond that first year, I think you mentioned that covers your first year. What is unlike the LLCs, there's no renewal or anything here associated with this. It's just
No annual filing fees.
okay.
Yeah.
Okay.
If you're thinking to yourself, is it worth it or not? If you go through the rest of your life, your professional life, and knowing that because this one investment you make, you're probably not going to pay significant amounts of taxes the rest of your life. Is it a one-time investment like this? I thought so. Everybody has to make a decision on their own, but I think it's
right. Yeah, well, I mean, comparatively, when you're talking about real estate and we're dealing with transactions that are hundreds of thousands of dollars per transaction, I guess I didn't really even consider a cost being an issue at that point. But it's all mindset, right?
Yes, exactly.
So well, Don, let's jump into the rapid fire questions if you have time. So first of all, we're all have seen the late night infomercials, get rich quick, no money down, you can pick your poison.
Mhm.
But what one would you like to bust right now? What is one of those real estate investing myths you'd like to just say enough is enough?
Stop doing those infomercials on a yacht. I would be slogging through some cleanup of a house, you know.
Yeah, I had that same experience when I was down in the basement of a house that had recently was flooded.
Mm,
Past my ankles in water trying
yeah.
to deal with a sump pump that it wasn't working, replacing a sump pump. Yeah, I hear you. What book would you recommend, or what are you reading now?
The book I would recommend, I would say the one that changed my life, and it's old school, but it still holds up, is Think and Grow Rich.
Sure.
Absolutely. Because
Napoleon Hill.
the biggest thing that I learned from that is never quit. And I'm sure you've
Yep.
read it. You remember the
Yep.
example of the guy that was what 2 feet away from a gold strike and he quit, and
Yep.
this came in and just reaped all the riches. And that was a lesson, right? Because you never know, when you're going to hit something. And I've been doing this now for 20 years. I had my own business before that. The biggest lesson that I've learned in my entire life is that if you just do something every day towards your goals, you will succeed. It's just a matter of time. That's it.
Right.
But it
Right.
doesn't usually come quick. Whatever you want to say, the universe, higher power seems to want to test you first.
Right. Well, what is the best piece of business advice you've ever received?
Just what I said. That one. Same one. Just don't quit. Just
Yep.
don't. Yeah.
So, what is your biggest real estate investing mistake, and what did you learn from it?
In 1983, I went to a Robert Allen No Money Down seminar. I drove all the way overnight from St. Louis, Missouri to Cincinnati. And I went there just because I wanted to be a real estate investor. Even when I was 18, I wanted to do that. And so I learned a lot, but I was a little scared. I didn't really do something, but I still had the stuff. I still read it. I still thought about it. Fast forward a few years later, I was in university, and I was dabbling in real estate. And this was in the mid '80s, and this was when the tax laws changed. And so a lot of professionals like attorneys and doctors, they had real estate mostly just for the depreciation. I was offered a fourplex for free, a free and clear fourplex, because the doctor didn't want to have any capital gains. He didn't want to pay taxes, so he was going to give it to me. I walked to the closing table and freaked out and left.
Really?
Yes. And I wasted 12 more years before I got back into real estate. And I thought to myself, so don't be afraid. There's always if the deal is good, you can find money. If the deal is good, but you don't know how to put it together, you can find someone to help you. Okay. You can always find resources. Getting the deal is always the hardest part.
Yeah, that makes a lot of sense. So if you could go back in time and give your younger self one piece of advice, what would it be? And I'm guessing it's don't run from that closing table.
I think it was the idea that I had to be educated to be successful. And I have a degree in Russian language and economics from a Russian university, because I spent a lot of time in Russia back in the 90s, late 80s and through the 90s. And I got an MBA in finance. And I can tell you that none of it did me a lick of good. None of it.
Yeah. It comes to something that I kind of get on my stool and rant a little bit right now. I think one of the things that we've neglected too, when it comes to high schoolers before they go into college, is simply sit down and educate them on the concept of return on investment.
Yes.
And they should be running that calculation every time they're considering a college degree, because that's the only way we're going to really get people educated enough to understand that underwater basket weaving isn't a viable career choice.
Yes.
So anyway, now I'll get off my, I'm preaching to the choir. So with that, is there a question or concept you wish we would have covered here tonight, Don?
How my good looks helped me in my real estate career, but I guess we could talk about that some other time. But other than that, no.
Well, Don, this was a great conversation. Again, it is financial freedom, the number 4, the letter U, .now.site. And I'll make sure to have that link in the show notes, but Don, I hope you'll come back again sometime. Maybe we can go a little deeper on the whole short sale side.
Yeah, I'd love to talk about short sales. They're coming back, by the way.
Yeah, I have a feeling they are. And thanks to the economy, right?
Yeah.
So, well, we'll talk to you again next time.
Thank you.